as a former regulator, now in the private sector, and let me perhaps give a perspective from the private sector. Disruption is coming to finance, just the way it has disrupted other industries from advertising to retailing. That should not be surprising, for finance is an information business. But finance is also a regulated business, and it is regulation that will determine whether and how incumbents and new entrants can compete as technology continues to develop. And one aspect, therefore, is that regulation, at least as far as firms are concerned, poses a risk. Perhaps I might refer to the Brexit comment that Alex made, a promise that legislation would be in place to ensure contract continuity. Quite how that promise can be made is a little bit of a mystery, at least to me, given that this government has just lost a vote in the House of Lords, and given that there is a distinct possibility that this government may not last until the Brexit date. But perhaps Alex can inform us as to how this promise can be kept. Advances in technology are making data more readily available, as well as cheaper to store and process. Indeed, advances in technology are making the cost of storing, processing, analyzing, and communicating data to approach zero. That has profound implications for finance. They lower the cost of providing financial services while offering the potential to improve their quality and to reduce risk, the benefits that Megan referred to. But they also threaten to reduce margins, for the new technology opens finance to new entrants free from the burden of legacy systems. There is also a dark side to the new technology. It facilitates the dissemination of rumor and false information. This can greatly accelerate the liquidity pressure on financial institutions, as well as increase the potential for market abuse. Again, factors that both Megan and Alex mentioned. The new technology also greatly increases the threat from cybercrime and cyber terrorism. Indeed, some of the most skilled and earliest adopters of the new technology are either criminals or terrorists. As finance is a regulated business, as I've said, it will influence the course that disruption takes. And it is the answers to three questions, I believe, that will determine that course. The questions are, first, how will regulation and supervision incorporate the new technology? To my mind, it already largely does, in the sense that it demands that incumbent banks have up-to-date data management systems and that they keep them at the cutting edge. So implicitly do various supervisory demands, including without limitation, stress testing, intraday liquidity reporting, and resolution planning. Indeed, in my view, there is no way that you can meet the demands for intraday liquidity reporting without employing the latest technology. Although banks can undoubtedly do more to improve their systems, this is not and cannot be the whole story. More is necessary and more is possible. Policymakers have significant choices to make regarding the definition of data, the ownership of data, access to data, and accountability for the accuracy of data, as well as for the responsibility of the cost of collecting and maintaining that data. As an example, take open banking. The question of whether a bank can, as an example, take the question of whether a bank can allow third parties to access the customer's data. This is very strictly controlled, and outsourcing, even to affiliates within the group, is generally subject to restrictions, particularly where the third party is based in a foreign jurisdiction. Such restrictions can be counterproductive. Take, for example, the obligation to run checks on the requirements on the checks on the customer for know your customer purposes, or the requirement to determine a supplier's reliability and resiliency, the four technical companies that one mentioned. Take Microsoft as an example. Is it really credible to have 4,000 banks around the world giving Microsoft a once-over? Or should one have a utility that does an in-depth review, and will one get a better result from that in-depth review at a lower cost to society as a whole and to individual banks? No points for guessing where I would come out on that. The second question, should the same rules apply to all? Should the same rules be one set of rules for banks and another for non-bank fintechs? In the interest of promoting innovation and competition, policymakers are leaning toward allowing new entrants to take over the relationship with the customer, as well as much of the reward, while leaving the risk and responsibility with incumbent banks. Not quite the way that Megan put it, but perhaps the way that incumbents see it. Take payments as an example. In the EU, the Second Payment Services Directive requires banks to allow third-party providers, if the customer gives her consent, to access the customer's account and to initiate payments from those accounts. Banks cannot refuse such access, and banks cannot warn customers of the risks of allowing third-party providers access to their accounts. Although the law places responsibility on consumers and responsibility on the third-party providers for any errors, will politicians really force consumers to accept liability and losses if the third-party provider fails or commits fraud? Or will they turn to the banks to do so under the so-called and oft-used deep pocket theory of liability? A second example is peer-to-peer lending platforms. Platforms allow sponsors to disclose unaudited information about unlisted financial instruments, namely loans, to non-professional investors without the platform having to take responsibility for either the accuracy of the information disclosed or the appropriateness of the rating that the platform assigns to the borrower. Could a licensed bank do the same? Could it do so within the group? I think not. Third question. Should the central bank be a player as well as an umpire in financial services? Central banks are currently exploring how digitization could enhance the current role of central bank money in clearing and settlement infrastructures, as well as the pros and cons of issuing digital currency more broadly to the general public. At its broadest extent, anyone could have a central bank digital currency account at the central bank, just the way that anyone could have in his pocket a note from the Federal Reserve, the European Central Bank, or the Bank of England. Such a central bank digital currency would be innately superior to alternative digital currencies such as Bitcoin. As central bank money, a central bank digital currency would be the quintessential store of value and the ultimate source of liquidity. Such a central bank digital currency would not only replace cash. It would, at least in my view, displace deposits. Now, macroeconomists see significant benefits in the central bank digital currency. In theory, it could simplify the transition mechanism, and in theory, it would remove the zero lower bound. Quite why paying negative interest rates is going to make people better off is another question, but that is macroeconomics. A freely available central bank digital currency, however, poses significant technology, security, privacy, and legal challenges. It would also imply a much greater role for central banks in determining the allocation and pricing of credit, and it would tend to undermine central bank independence. Small wonder, then, that no central bank has been ready to stake its reputation, its citizens' wealth, and its nation's fortunes upon a central bank digital currency. Vitor Constancio, the Vice President of the European Central Bank, reckoned that it would be a profound disruption to banking as we know it and is therefore unlikely to happen. Maybe for the immediate future, but think ahead, as we're being asked to do today, 5, 10 years out. The technical issues have been resolved. The legal challenges have been solved. After the crisis, there will be cries, is not banking too important to be left to bankers? In such a circumstance, would there not be a possibility that central banks would issue a digital currency that would in fact displace deposits, and therefore much of the banks? In sum, finance does have a future. However, it may not belong to today's financial institutions. Thank you very much.
We've got a ton of questions already. There was one very specific one you raised for Alex. I don't want us to forget that, but I do want to open it out into a bit of a discussion now. We've got, since we started a bit late, I'm going to arbitrarily decide that lunch gets moved back by 10 minutes. So there we are. So we've got about 15 minutes or so. Let me just try and get comments on that or questions from the floor before coming back to our three speakers. I think we've got mics roving around somewhere. So who would like to make the first comment or ask questions? There's a comment right there, next to the microphone. Excellent.
Hello. Thanks for your insight. Being sort of seeming to be ungrateful. I'd like to disinter the body of something that I think we all thought was dead, still hasn't been addressed correctly, which is the issue of bail-in. The design of, if you like, the gaming or trying to outgame the market, which is full of people who are basically trained to game it. And I just wondered if you could make a comment on bail-in as a true and a risk that is not gone away.
Okay, who would like to offer any thoughts on?
Yeah, should I take that one?
Yeah.
Well, if you maybe you mean bail out as the risk. All the reforms since the crisis have been designed not just to make banks stronger, but also to make the system fairer by taking away the need in any future downturn or crisis to bail out institutions. I mean, in the last crisis, regulators were faced with the slightly invidious choice of bailout or economic catastrophe. And in some cases, bailout was the choice. And in Lehman Brothers' case, catastrophe was the choice. That just highlighted the sort of invidious choice people were faced with. The solution to that Hobson's choice is actually to create legal powers and legal frameworks to enable the authorities to grip a failing bank and resolve it, rather than just allow it to fall into bankruptcy and all the disruption that implies. So the legal framework's in place. Banks now have in place the debt that can be bailed in. They have a little bit further to go, but a lot of it's there. And once they complete the necessary structural changes to their own organizations, which, by the way, includes ring-fencing of their domestic retail deposits, we will be in a position to grip even a major bank and, if it's got into trouble, recapitalize it and reopen it as new bank without disruption to the depositors, the other creditors, or other exposures. That will remove this invidious choice. We're not there yet, but we're well on the way there to solving the problem of bailout. And when you look at what the market is saying for the implied state subsidy for banks because of this choice, it's basically gone from about £50 billion for the UK banks to about £3 billion for the UK banks. There's a bit more to do, but that problem is being addressed.
Agree.
Yeah.
Okay, I can
Absolutely.
see. Okay, so there's a hand back there, and then we'll come to Tarun at the front.
Excellent panel. Thank you very much. Alex, I wonder if you think that the regulatory changes will allow central banks, and I think you said this in the answer to the last question, will allow central banks to go back to what Badgett said they should do, which is to lend freely in times of panic at high interest rates, and be perhaps less concerned with moral hazard because they're more convinced that the institutions that they're bailing out are fundamentally sound. So I do hope that the regulation is taking us in that direction. Megan, I was very struck by your observation that the supply of research is going to come down. And I think it's a general problem that when you do a lot of unbundling or make costs explicit, that you get an under-provision of things that were happening before. And I worry, I used to be a private banker, about the under-provision of financial advice, partly because customers are it's very difficult for a customer ex ante to understand the value of financial advice. And I think there is therefore a systematic tendency, or there may be, to demand too little of it, which again leads to problems of its own. I'd be very grateful for your comments on both those.
Megan, you
Shall I go first? The research point, I didn't say was going to lead. I said the risk it might, which is just too early to say, but it's a risk we're just going to keep an eye on. The financial advice point, I would agree absolutely with what you've just said there. We have to be very careful that regulatory interventions don't have unintended consequences around the provision of things like financial advice. Now, in the UK, we had the RDR a few years ago, Retail Distribution Review, sorry, jargon. One of the impacts of that, I think, has been a shrinking of the availability of advice for people. There are now steps where firms are now coming back into that market. And technology is one of the reasons, and one of the enablers perhaps there, which is one of the reasons why we need to be very open to how that might operate. But you're quite right, that it's really important that those things are still there. It's overwhelmingly important in the UK if we look at what some of the key issues where we need every member of society to make a better and appropriate provision for their long-term well-being, that these things are available. But we need to keep an eye on how it's happening and make sure that regulation isn't a barrier to some of these things, but rather an enabler.
And will you ensure that that advice contains warnings that the government will change policies?
He stuck the question in again.
Yeah, clearly not. But I mean, advisors have to make statements, but we're not in control of tax policy or anything like it. So I think advisors do tend to say, in fact, that this is on the basis of current tax arrangements, and tax arrangements can change. But no, clearly that's outside our world and into a different world.
Yeah. So I just pick up on the liquidity point very briefly. The answer is yes. I mean, our liquidity framework has moved miles since 2007. We actually have a well-defined framework for providing liquidity to the banking system in a crisis, and outside, for that matter. The development of stronger banks and resolution regimes means exactly as you say. Actually, we should be able to provide liquidity in a Badgett-style way through all sorts of acronym soups of operations, so that liquidity is basically, or as we use the phrase, open for business. Our balance sheet is open for business. That's enabled by these other developments.
And had you had those liquidity policies in place at the time of the crisis, would the crisis have taken the same course?
I don't think it would have taken exactly the same course, but what the recapitalisation, we're digging up 10 years ago here, what I think the recapitalisation revealed in, when was it, September, October?
October 2008.
08, was that actually, and RBS was the clearest example of this, was that the fundamental issue with some UK banks at least was a solvency one. It took a massive slug of government bailout, to go back to the first question, to actually restore confidence in the banking system. There was no amount of liquidity, looking back with hindsight, there was no amount of liquidity that could have solved that particular problem. But the solution is bail-in regime, stronger banking system, plus, as you say, then the icing on the cake, the central bank can be open for business. I think one has to come before the other.
We're going to come back to more of Tom's killer questions in a minute, which I haven't forgotten. Tarun, your hand's up. Have been up for a while.
Thank you. So I have a question about the technology bit that several of you alluded to. So obviously, if you want to have sort of lots of technological advances in the financial system, then what you have to have is a regulatory regime that's fit for purpose to deal with the fact that there's a lot of flexibility to operate. Flexibility in the hands of regulators inevitably means more discretion, regulatory discretion. And the problem is that with technology, there's also unprecedented declines in trust in sort of centralized authorities. So how do you manage this kind of transition where you have to have more discretion to operate in an ever more hostile environment for discretionary action?
I'll have a first go at that, but I'm sure Alex will have a view. It's a challenge, is the only real answer to that. You're quite right in the way you articulate some of those issues. And that's why, in a sense, I finished by posing some of these questions, because they are front and center in a lot of our regulatory debate at the moment. We need to be able to exercise discretion in an appropriate way, to be flexible, to be open for business, to be open for change and development. But the only way we can do that is if we are clearer, perhaps, about the outcomes we're trying to achieve. So I think we can be quite precise about outcomes and then be reasonably flexible about how firms deliver them. And that, I think, is the way through this particular set of challenges. We live in a world where, yes, discretion is not necessarily as trusted as it might have been in the past. But even if it were absolutely trusted, we'd still have the same issues around being. You have to be really careful about hardwiring certain solutions here. It's a really difficult balance we have to draw. So I go for clarity, certainty, and precision on outcome, but a high level of flexibility and creativity in how you achieve them.
Yeah, I couldn't agree more with that. It just reinforces the need on all policy fronts to act if you're delegating it to an unelected, God forbid, official or officials, that you are give as much clarity as possible about the outcome you desire. Now, monetary policy, of course, is the poster child for this. 2% inflation. You've got a discretion to do it. Don't screw it up, but it's 2% inflation. And I will know if you are deviating from what I've tasked you with. Financial stability, much more difficult to define the outcome. So we've been thinking about how we can provide a bit more clarity about the outcomes. The FCA has been doing the same. And an example of this, just a small example, is bank stress testing. We say every year, you haven't told us specifically how resilient you want the banks to be, Parliament, but we're telling you the way we interpret the outcome you've told us to achieve is resilience to this scenario. And people can disagree with our judgments, but that's what we're aiming for. And that means we can be accountable for it. And I think the key to all this, and it goes to Megan's point about clarity, is that in the end we can be held accountable rather than just for delivering what we always wanted to deliver.
I want to come back to one of the big questions that Tom raised, which is about central bank digital currency, and put the question, I suppose, to Alex, because he's from the central bank. And the question is this. It sounds like a good idea. It sounds like it might be an efficient thing. Bit of a side effect. Wipes out all deposits with commercial banks and is the end of the banking system. Good idea?
Discuss.
Yeah.
Discuss. Well, okay, so look, central bank digital currency is not, central bank currency is not a new issue. It's something that's come up in academic research and other questions for many years now. New technology has given the question a new lease of life. But think about it this way. Everybody now has access to digital money, pay for things with your watch, that has an exchange rate of 1-to-1 with central bank money. It's called an insured deposit in the banking system. Looked at like that, what's so exciting about the central bank digital currency? So it's not actually the case that macroeconomists generally think this is a sort of novel or great idea, and isn't certainly a pressing one. It is worth a research agenda over the longer term, though, for the following reason. What some of these crypto assets show, I think, is, at least, they're not currently anywhere near it, but the potential for technology to create alternative payment systems that may one day, they're miles off it now, may one day be more efficient than the mainstream one, may one day meet society's preferences for doing everything in a distributed way without these central intermediaries called banks. It's worth research, so that if we get there, probably not in my lifetime, but if we get there, then we're ready to respond to that, because moving to a non-state or non-mainstream payment system is like a return to the gold standard. You lose the discretion to actually set your own monetary policy. So it's worth a research program. But I think that side effect is a really serious one, and is also unnecessary, given that everybody has access to digital payments now with a currency that has a one-to-one fixed exchange rate with the central bank money. I get very excited about these things.
I can see.
Yeah.
But not all deposits are insured.
No, but if you can have, the vast majority, yeah.
We're fast running out of time. I know there are some people that are still hands up, but I want to come back to a question, and I'm going to let Tom ask it again. His question about continuity of contracts and what happens if the government falls and all the rest of it. Can you pose it sort of succinctly once again? I don't want to let Alex off the hook before you.
That's very apparent.
Yeah.
Let me pose it from the EU 27 side of the line. There is not the same type of response that the Bank of England has given, but there is not an assumption that it will be all right on the night, but a urging of institutions headquartered in EU 27 member states to act as if there will not be a withdrawal agreement, and that the possible cliff edge effects will come into play.
Yeah. So this is actually it's a very good question. It's a repeat of one I got at the bruising Treasury Committee encounter yesterday. I thought I was out of that. And I'll give you the same answer. So in the UK, we had there's another Hobson's choice here. Given the gap between the political agreement on transition and possible legal agreement, you can either rush to adjust, as Tom describes, risk and disruption, or so that you're covered for all eventualities, or you can basically give it the benefit of the doubt and have a backstop of a temporary permissions regime in case not. That's the way the UK has solved that Hobson's choice, and the regulators and the government together have solved that. Bearing in mind, though, that we cannot, of course, give people complete political certainty. We live in a democracy.
We could novate everything to you.
On the contract continuity question, of course, it does take two to tango.
Indeed.
On this point. And this is an issue, actually it's in the published version of the speech. I left it out for time when I was speaking. There's about 26 trillion notional value uncleared derivatives between UK and EU counterparties that could be disrupted in a Brexit where either party doesn't have permission to serve the other. Our approach will deal with the UK half of that. All I will say is what I said yesterday, which is that there is, and what the governor said in December, there's a widespread appreciation, and an increasingly widespread appreciation, actually, in all parts of these issues on the financial stability front. And we collect together, Megan talked about regulatory cooperation, we together continue to strive for a position where you can actually have confidence. We're not there yet, but we strive for the position where you can have complete confidence that not just the new flow of financial services is backstopped, but existing contract continuity can be as well. But this is all part of focusing regulation on the outcome for the economy rather than on the words of the regulations themselves.
Yeah. If I can add to that, when I speak with my regulatory colleagues across Europe, which I do on a very regular basis, always did do, but increasingly so, there is absolute recognition that this is a symmetric risk. It's not a UK question. Yeah. It is a completely symmetric risk across the whole of Europe. So there is strong understanding in the regulatory community that a solution is required here.
When we set exams at Imperial, we're normally advised as academics that you shouldn't have the first question the most difficult one, because it's bad, so that students get very nervous and they get off to a bad start. So I think we ended up with a difficult one there, but good answers. We've overrun. But I really want to thank very much our panel, Alex, Megan, Tom, for what I think has been a really interesting session. So thank you very much indeed. Thanks.